Welcome back to the Ultimate Trading Guide. In Chapter 1, we talked about why education is the backbone of trading, and how continuous learning sets you apart from the crowd. Now, in Chapter 2, we're going to roll up our sleeves and dig into one of the most exciting and powerful aspects of trading, technical analysis. Think of technical analysis as your decoder ring for the markets. It's what allows you to look at a chart, those squiggly price lines that can look intimidating at first, and actually see a story unfolding. It's how you begin to understand where prices have been, where they're likely to go, and how you can position yourself to take advantage of those movements. So why does technical analysis matter? Well, financial markets are driven by human behavior, by fear, by greed, by herd mentality. And that behavior leaves a footprint on the charts. When you learn to read those footprints, you gain an edge. Suddenly, price action stops being random noise, and starts to look like a language. It tells you when a trend is gaining strength, when it might be stalling, or when a reversal could be just around the corner. Let's break it down in practical terms. One of the first things traders learn are chart patterns. These are recurring formations, like head and shoulders, double tops, triangles, and flags. Each one signals something about the balance between buyers and sellers. For example, a head and shoulders often tells you a trend is running out of steam and may be about to reverse. A triangle, on the other hand, usually means the market is consolidating before making its next big move. Once you recognize these shapes, it's like having a roadmap that points to potential opportunities. Another crucial concept is support and resistance. Think of support as the floor, a price level where buyers tend to step in and stop the market from falling further. Resistance is the ceiling, a level where sellers tend to push back and prevent the market from climbing higher. These levels become reference points for making smart entries and exits. For example, if a price has bounced off the same level 3 times before, you know that's a critical zone to watch. And if it finally breaks through, that often signals a strong move in the new direction. Then we have indicators and oscillators. These are mathematical tools that help you interpret price action more clearly. Moving averages, for instance, smooth out the noise and show you the overall trend. RSI, the Relative Strength Index, tells you when an asset might be overbought or oversold. MACD, the Moving Average Convergence Divergence Indicator, highlights momentum shifts. And Bollinger Bands? They expand and contract with volatility, helping you see when prices might be stretched too far. Used wisely, indicators give you confirmation and context, but remember, they're helpers, not crystal balls. Volume is another key piece of the puzzle. It tells you how much participation is behind a price move. If the market is rising on strong volume, that's a sign of conviction. If it's rising on weak volume, the move might not be sustainable. Volume often acts like a lie detector, confirming whether a breakout is real, or whether it's just a false alarm. Once you've got the basics, you can start to level up your game with more advanced techniques. Looking at multiple time frames, for instance, is a simple but powerful habit. A stock might look bullish on a 5-minute chart but bearish on the daily chart. By zooming in and out, you see both the forest and the trees, and avoid being blindsided by bigger trends. Another advanced approach is price action trading. This means stripping away most of the indicators and focusing purely on the raw price movements themselves. Candlestick patterns are part of this, little formations like dojis, hammers, or engulfing candles that reveal shifts in sentiment in just a single bar of data. When you start seeing how price reacts at key levels, you begin to feel the pulse of the market without needing a dozen overlays on your chart. Backtesting is another tool every serious trader should know. It's the process of testing a strategy on historical data to see how it would have performed. Think of it as a rehearsal before the live show. Backtesting doesn't guarantee future results. But it does give you insight into whether your ideas have merit or need refining. It's how you build confidence before putting real money on the line, and here's a tip that sounds simple but is incredibly powerful: keep your charts clean. Many beginners make the mistake of loading up their screens with indicators until they can barely see the price. The truth is, less is more. A clean chart helps you focus on what really matters, rather than drowning in signals that may conflict with each other. When you bring all of these elements together, chart patterns, support and resistance, indicators, volume, multiple time frames, price action, candlesticks, and backtesting, you begin to build a complete toolkit. Technical analysis isn't just a collection of tools, though. It's a mindset. It's the discipline to read the markets objectively, without letting your emotions dictate what you see. By the time you finish mastering these basics, you'll be able to look at a chart and see far more than just random price movement. You'll see stories. You'll spot opportunities. You'll anticipate risks. You'll start trading with clarity and confidence, instead of relying on hunches or luck, and if you want to go deeper, there are some incredible resources out there. John Murphy's technical analysis of the financial markets is considered a Bible in this field. Thomas Bulkowski's Encyclopedia of Chart Patterns gives you an exhaustive playbook for recognizing every formation you can imagine. And tools like TradingView make charting intuitive, powerful, and accessible wherever you are. Across these lessons, you'll discover how to build a trading plan that actually fits your life, how to manage risk like a professional, and why consistency is more important than chasing big wins. You'll learn how psychology shapes every decision you make and how to protect yourself from those emotions that can sabotage your trades. You'll also hear about tools and routines that can keep you grounded, strategies for adapting to different markets, and insights into avoiding some of the biggest mistakes that hold traders back. This introduction is just the beginning. Each tip deserves its own space, because trading is not something you rush through, it's something you build, step by step. So, after listening to this, I encourage you to go deeper into the next audios, where we'll unpack each of the 10 tips in detail. By the time you've gone through the full series, you'll have not only a stronger grasp of what it takes to trade systematically, but also the confidence to put these lessons into practice in your own trading journey. So take a breath, get comfortable, and let's begin this journey together. And when you're ready, don't forget to move on to the first tip, you won't want to miss it. Stay focused, and let's dive into tip 11, trading chart patterns.
Thank you for listening to the Ultimate Trading Guide for Novice Traders, brought to you by bellsforex.com AudioWorks. We hope this chapter has given you the insights and confidence to start your trading journey with purpose and discipline. Stay curious, stay disciplined, and keep learning. Your trading success starts here. If you find value in this video, don't forget to like, subscribe, and turn on notifications so you never miss a trading tip. Your support helps us grow the channel and bring you more free trading education. And of course, share this with anyone who's starting their trading journey. It might be the nudge they need to trade smarter. You can visit bellsforex.com to access the complete guide for free, or grab your copy on Amazon in Kindle or paperback. Until next tip, trade smart, and trade confidently. Happy trading!